My name is Alissa Garcia. I'm an investment relationship manager and the communications manager here at Schneider Wealth Management Advisors. And earlier this year, we began a video series called Coffee with Alissa, where I interview a broad range of people within and outside the Schneider family. And these videos are meant to answer commonly asked financial questions and to discuss investment and financial planning related topics. So we hope you've enjoyed this series and that you continue to watch the new content that comes out. It comes out monthly, both via email and our social media channels. So if you haven't already done so, please take a moment to follow us. We have YouTube, Facebook, Twitter, and LinkedIn. And you can also sign up for our email communications so you don't miss out on any new content. So today, it is my pleasure to welcome and interview Mike Savage. He's the Senior Investment Portfolio Strategist from Charles Schwab. And Mr. Savage has more than 35 years of investment experience across a wide range of asset classes as an analyst, a portfolio manager, and a client-facing professional. He's recognized for his expertise on strategic beta strategies. And so he represents Schwab Fundamental Index ETFs and mutual funds, all with clients, advisors, and the media. He regularly speaks at industry conferences and shares insights on strategic beta strategies with media outlets that include Investment News, ETF.com, Asset TV, Ignites, and many others. Mike's practical investment expertise, combined with his experience interacting with investors, can provide audiences with a unique perspective on behavioral finance and strategic beta issues in the context of today's market dynamics. Mike, really appreciate you joining us today. How's your morning going?
It's going great, Alissa. Thank you for having me.
Yeah, absolutely. Of course. We are grateful to have you with us. We're excited. You have quite an impressive bio. So if it's all good, we'll get started jumping into the questions.
Sounds good. I heard that bio and I wasn't sure you were talking about me or someone else. I got to tell you, my family's not too impressed. I mean, my kids don't think I know anything.
Well, we're impressed. So hopefully they will be too. But so earlier this month, we posted a video interview with a local therapist about behavioral finance. We discussed the common biases that exist in the financial areas of our lives. And so I'd like to start just by reviewing where our biases come from and how the human brain has a big influence on an individual's investor biases. So would you please provide us just a basic overview? How does our brain contribute to these biases?
Sure. And as you mentioned, these behavioral biases, investor biases are really elements of human behavior that affect all of us as investors. And as you point out, they really stem from two portions of the human brain. One is, as shown here on the chart, the limbic system, which is in the center extending to the rear of the human brain, and it controls our impulsive reactive behavior. The fight or flee reaction is driven by the limbic system, and that's one big key driver to the range of investor biases that we see. The other portion of the brain that influences investor biases is the prefrontal cortex, which resides more in the front of the human brain, and it tends to respond to observations or processing of some data. And it's a different type of bias, and we'll go over that, but it also comes from a portion of the brain. As you mentioned here and show here, that it turns out in the history of the evolution of the human brain, the limbic system was developed first. The brain was developed from the back to the front. And it's one reason why signals we get from the prefrontal cortex, which was developed after the limbic system, often can't override the signals we get from the limbic system. So I promise this is really the only physiological chart in this whole presentation. We're not going to have a test on this or anything like that, but suffice it to say that there are two big parts of the brain that drive most of the investor biases that we see.
Well, just like there's two parts of the brain that drive it, I think investor biases can frequently be grouped into two different categories, each corresponding to signals we receive from the brain. So could you identify these two categories and give some examples of the common biases that fall within each of them?
Sure, that's exactly correct. We tend to categorize the broad range of investor biases into these two categories. One is the emotional group of biases and responding to the idea of I feel the market's had quite a run here and it's due for a downturn. So maybe I'll take some money and move it out of the market and put it into something safer. That's an emotional type bias. The other group is the cognitive type bias, which is processing some observation or experience. A broad case example might be, the Federal Reserve is raising interest rates. That means that at least they think that the economy might be subject to some inflation. Well, maybe I'll look for some kind of inflation hedge as a result of that observation. So those are the two broad categories. On the emotional side, which by the way is driven more from the limbic system than the prefrontal cortex. Remember, the emotional is responding to I feel, more of a gut reaction. Some of the more common emotional biases are regret, failure to make an investment based on the regret of a past investment that didn't work out for you. Loss aversion, playing it too safe and not taking a reasonable level of risk given your circumstances. And this is one we see quite often today, overconfidence, having an unreasonable level of confidence in one's own ability in terms of making investment decisions. On the second group, the cognitive group, remember, responding to I think, and often in conjunction with the processing of data or observations. Some of the more common biases there are anchoring, making a decision to buy or sell or measuring performance based on some fabricated data point. And I'll be honest, I'm guilty of this, or was, for many years. I used to make individual stock selection decisions based on the previous 10 years of a stock price. And that never really worked out for me. And I've come to learn the hard way. Now, I've spent my life in the investment business. I've come to learn the hard way that stocks don't necessarily trade in 10-year cycles. So there have been many stocks where I bought and sold based on a 10-year cycle that have gone up, I don't know, 5-fold or something since I sold it. And I missed out on that because I was waiting for it to get back to a 10-year low end. That's a classic case of anchoring. Another one in this category, cognitive biases, is herding. A lot of investors getting into some kind of investment when they don't really understand what it's all about and simply in it because they think everyone else is in it, or maybe they hear about it on the news networks or what have you. And the last one that I might spend a little time on is this issue of availability. And broadly, availability is a bias that means you're making what should be a long-term investment decision based on information you're hearing right now, which is by nature short-term. And a classic case, and a lot of people don't understand this, is CNBC and the other financial news networks, because a lot of people are making decisions based on what they hear on CNBC today. And CNBC may not really be acting in an investor's long-term best interest.
No, definitely. And it's so when the headlines pop up, they can often be very convincing, and they tend to, hot stocks to buy, right? For just a small reason that it'll attach to it. And I don't think a lot of people really dive into the research behind that, right? It's like, well, Jim Cramer said it, so it must be a good stock to buy.
That's absolutely correct. And I'll just quickly interject that, maybe it's worse when the market's in a downturn, right? Because think about the people and the tone that they have on CNBC. Every talking head, for lack of a better description, and to be honest, there are many Schwab senior people that are invited on to CNBC. I don't mean to disparage everybody who comes on CNBC, but in a market downturn, many of them say things like, yep, I saw this market turning down and I went to cash a month ago. You see them time and again say that kind of thing, and that really plays on people's emotion and often gets them to act in a way that's not in their best interest.
So a third section of biases that I find very fascinating are generational and learned biases. And I think for our audience, these are the biases that are either learned from our personal experiences, what we're taught by our family, in our upbringing, also from our age and the social norms that exist within our society around our generations. So Mike, how have you seen these biases impact people throughout your career? And can you elaborate on some of the differences that exist between generations?
Sure. And, it's well understood that an individual's investor bias are at least partially driven by their demographic class. And we do see some general investment themes among the investor classes. It's hard, frankly, to make blanket statements about any demographic group and how they might invest. For example, I'm the youngest class of the baby boomers, born in 64. Am I going to invest like someone who was born in 46? Perhaps not. Nonetheless, we do see some themes that we can kind of discuss. And in the interest of time, I'm only going to focus on two of them. The baby boomers, again, I'm the youngest class of the boomers, and the millennials. And the millennials are surprising us. You see that millennials are showing to be far more conservative and have as their preferred investment vehicle cash. You think the younger folks are going to be more of a risk taker. And certainly some are. But on average, we're surprised at how conservative they're showing us to be and have as their preferred investment vehicle. We think there are a couple of reasons for this with regard to millennials. Many of them expect to have many more employers than their parents did. Many of them are taking jobs in high-risk industries and high-risk companies. And for that reason, many millennials believe they're going to have significant periods of unemployment, some of it voluntary because they want to travel around and take time off, but also involuntary because they're taking jobs with higher risk industries and higher risk companies. Another factor we think driving this higher level of conservatism is the market environment they've seen. These two charts shown here show the S&P 500 through each of the demographic classes' so-called formative years. They're not the same exact years. However, the period high school, college, job market, family is represented here for both a millennial, which is on the right, and a baby boomer on the left. And just take a quick look at it, and you can see there's quite a bit of volatility here on the millennial chart. That's quite a bit of up and down. That by the way, extends from the late 90s to the early 2010s, like 2015, 16. And let's talk about that real quickly, all right? So, even the older millennials were not investors during the tech bubble and crash of the early 2000s. However, many of them had parents or had friends who had parents that worked or invested in the tech industry. So we think at least some of the millennials were aware of fortunes made or lost, right? Now, moving forward into the 2005, 6, 7 period, you might all remember, if you could fog a mirror, you could get a home mortgage for $500,000, depending on the particular market. Many of the older millennials became first-time home buyers, and some of them found themselves underwater on their home and mortgage, having a home currently worth less than the mortgage that you used to buy it. And so that's a lot of stress. Now, obviously, markets have come back from those two episodes, and if you were to extend this chart further, we've seen that it's come back even better than that. So, nonetheless, we think that this is one big input as to why millennials are showing us to be a little more conservative than we thought. Baby boomers, on the other hand, just quickly look at this other chart on the left. There were some bumps in the road there. We didn't think there were bumps at the time. I remember the crash of 1987. I was just graduated from college and working in the investment business, and I thought that was a very dark day. But we recovered relatively quickly from that, and since that time have done nothing but go up. So boomers are showing us to be willing to take an appropriate level of risk and to think longer term. Now, to be fair, certainly many boomers are already in retirement, and many others, like myself, are approaching retirement. So, time is of the essence for a boomer more so than a millennial, and that may also contribute to the idea that they're willing to take an appropriate level of risk and think longer term.
Well, and we certainly try to meet with not just our clients, but also their young adult children, so we can get started with financial planning, get them invested in 401ks, right? Start having these financial conversations early on to try to break, again, some of those generational and learned biases that have come from experiencing all of these events, so we can make sure that not just our clients, but also their children and their grandchildren get started on the right track as well. So when you brought up risk tolerance, just because of, the big, how well can we handle the big drops, all of those things. And we find ourselves this year, of course, in a period of extreme volatility, which we haven't really seen for a while. Understandably, emotions tend to run high and can often take over our mindset, even if we tend to be pretty even keeled. But one of the phrases I like to use with my clients, and I have been in meetings, is let's focus on what we can control versus what we cannot control. And we review the items, they're listed up here on the PowerPoint, but what's your asset allocation? And that correlates to your risk tolerance, how well you can withstand those ups and downs and the bumps in the road, especially when they're big bumps. We can also control our saving versus our spending, our short and long-term financial goals and projections. And perhaps I think the most important one right now, like we brought up before with the media, is we can really control what we choose to expose ourselves to. In an age where we are just bombarded, whether it's news or social media, with negativity, really big and scary headlines that often don't correlate with something big and scary. But of course, when they pop up in a red headline with a lot of capital letters and exclamation points, it can rock us a bit. But can you elaborate on these items? And please feel free to add anything that I missed if we can define, what we can control versus what we can't.
Yeah, I think this is a great theme. I firmly believe in this idea, and one that a couple of issues that I want to talk about. One of the things that we recommend for clients is to try and tune out the media, or at a minimum, try and diversify your media sources, right? Much like you would anything else. So I'm continually shocked at how many clients I see, particularly those that are retired and have the time to do it, how much time they spend in front of the financial news networks like CNBC. Our suggestion is to tune some of that out. To be honest and fair, we as a firm, Schwab, and we as an industry, financial services, have contributed to this issue, right? We all advertise on CNBC and the others. If you walk into one of our branches, you happen to see CNBC typically on a very large television blasting at you. So if it were up to me, we'd turn all those off. It's unfortunately not up to me, but I'm working on it. A related topic to this, very closely related, is the idea of trying to take the emotion out of investing and be aware that there are many sources, including the news, that are really coming after your emotion. They can really impact you there. So one quick story. I was traveling in Southern California and I went into a Schwab branch and was asked if I'd speak with a client. I soon found myself on the phone with a Schwab client who was absolutely distraught. He was distraught because he'd been a lifelong equity investor, been in the markets a long time. He had just gone to cash amidst a 15% market downturn. He saw markets going down. He was watching CNBC, and he got caught up in the emotion of people on CNBC and others saying that they had gone to cash. So he thought that's what he wanted to do. Well, the market had turned around. It was now up 5%, and he'd lost out on that 5%. And that may not seem like a lot to most people. And what's the big problem? But his personal circumstances had just changed, coincidentally. He felt he and his wife had adequate assets for retirement. However, his adult daughter had just gotten divorced, and his adult daughter and his granddaughter were now living with them. And it looked like he and his wife were going to have to support them for the foreseeable future. Now his assets didn't look so adequate, particularly in the face of a 15% decline. So I think it was a combination of those factors that forced him to sell and go to cash completely. What he wanted me to do was to tell him when he ought to get back in. And, I don't know what stocks are going to do next week, next month, 5 years from now. I have no idea. But I do know this. If I wanted to be in equity markets longer term and I was sitting on a big pile of cash, I'd carve it into buckets, I don't know, 5, 8, 10 equal buckets, and put it to work over an extended period of time. A year, 2 years, 3 years, 5 years, put it back into work, particularly if I was uncertain about the current level of prices or was concerned about it. And that sounds very simple to the folks on this call. It is simple. It's classic dollar cost averaging, right? But so many people forget that stuff and get caught up in the emotion of it all. And, that fellow didn't do a hallelujah when he got off the phone with me or near the end of it, but the tone of the conversation got a lot better near the end of that call than it did at the beginning. So at least he had some idea, a potential plan to get back into the equity market, which is what he wanted to do. So taking emotions out of it is another one of our suggestions. And it takes many forms, but certainly one of our suggestions to try to better acknowledge, work with, recognize the various investor biases and at work in our own decision making.
Well, that story actually segues nice into something else that I wanted to bring up, because we know that behavioral tendencies, they can greatly affect the outcome of financial plans and of portfolios, just like in your friend's situation. And I know Schwab has created a program for financial advisors called Biagnostics. It's a framework to help advisors incorporate behavioral finance into their practices to elevate the client experience by identifying and mitigating these behavioral and generational biases that can often stand in the way of clients achieving their long-term goals. So can you tell us more about why and how Schwab developed this program and how you were involved?
Well, there are some very senior people at Schwab that have long followed this issue of behavioral finance and how it affects investors, often to their detriment. And as a result of that work, we developed this program several years ago, well before the pandemic. And what it really does is it's got a couple of parts. What's shown here is the advisor guide. Another big part of the program is the investor guide. And we hand this out, or an advisor can have both, and the advisor can hand out the investor guide to investors, and investors will go through and go over the information that I sort of highlighted today. The investors do not have to listen to a presentation like this one. They can simply read the first 4 or 5 pages of this investor guide that works out quite well and goes over all the information and more than that I described. And then they go in and identify, what kind of bias they're likely to have, more of an emotional or a cognitive bias. And then they'll identify which demographic class they're in, because as I mentioned, a person's demographic class influences the biases they have. And then they'll go through a list of 10 ideas. I went through 2 of them. One is tuning out the media. We call it the media diet. And one is trying to tune out emotions. And we call that the emotional override. 10 ideas of things we can do right now, all of us, to better understand and work with the biases at work in our decision making. And what's happened is clients have looked at this as a friendly, no risk report card. And they've really gotten into it. Frequently, they'll call us back and ask for extra copies because they want to share it with their spouse, or they want to share it with their kids and get their kids to fill it out. And that leads to conversations between spouses, that leads to good conversations between parents and their kids, and often leads to great conversations between spouses, parents, and their advisor. This has happened time and again. The advisor guide that's highlighted here describes what to do with it. All right, so now we have these investors who identify as having more of an emotional or a cognitive bias. They go on to identify specific biases at work in their own decision making, like a loss aversion or anchoring, as I mentioned earlier, and how an advisor might use that information to tweak the portfolio a little bit to accommodate an individual's investor bias. And why might you want to do that? Well, here's a classic case that we see time and again. We have maybe a retired couple account, and they've been married a long time, 40 years, and either the husband or the wife drives most of the financial decision-making for the couple. Unfortunately, that spouse passes away. We all understand the surviving spouse can be something of a deer in the headlights. We also know that many times the surviving spouse leaves the previous financial advisor. That's never a good thing. But what if we'd gone to the effort as advisors to ask each of the couple to fill out this behavioral finance workbook? Well, the advisor can say, listen, you've demonstrated maybe a higher loss aversion, and we're going to, use that and modify the portfolio a little bit, maybe taking as appropriate, maybe taking assets out of riskier assets and putting them something in safer to accommodate the individual's investor bias. And that's one example of dozens that puts this to work. And the advisor guide, as I mentioned here, goes into more detail on how to exactly put this information that you've gathered from the clients to work.
Mike, you've been a wealth of information. We appreciate to have had the opportunity to meet and interview you. Is there anything else that we haven't covered today that you'd like to share with our audience?
No, I think we did a nice high-level overview of it. If there's certainly information, please reach out to the folks at Schneider Downs, and we can get this material to you. If there's interest, we can have another conversation about it, all those kind of things. So I certainly appreciate the opportunity and the time to come on the presentation today.
We appreciate you. Thank you again.